Well, as the conflict in West Asia deepens, what does this mean for the rest of the world and for India at large? We have seen benchmark indices slide in trade, extend that decline throughout the trading day. We have seen oil and gold rates surge as a result of this. We've seen Brent crude trade towards $75 a barrel. We've also seen some weakening in the Indian rupee today against the dollar. Well, to decode all of this, I'm joined by G. Chokalingam, market expert, as well as senior business economist Sanchita Mukherjee. Thank you so much for your time, both of you. First to you, Mr. G. Jokalingam, first to you, with West Asia being on the edge now, literally, each day we're witnessing developments there. Is it really time to brace for volatility in the markets in the near term?
Yeah, certainly. Definitely, at least for next few days, because all of us know that there has to be a reaction from Israel. The only question is the intensity of such reaction and target of that reaction. A lot of analysts at global level, they are fearing that Israel may target oil infrastructure of Iran, and in a worst case scenario, there's some people are fearing even attack on nuclear facilities of Iran. So it depends upon the target. In case it's going to be nuclear facilities, I think we should be prepared for another 2-3% fall in the Sensex and Nifty. If it is oil targets, maybe 1-3%. But eventually, this war will be like a localized one, like what we are seeing in Ukraine, and market also would start living with these kind of regional wars the way it is living with the war of Ukraine for the last 2 year or so. Why I am saying nobody is prepared for world war, because world war comes, everybody will be finished, and then we don't have to worry about the stock market also. So first of all, that is not possible at least for 1-2 decades. If it comes also, we don't have to worry about the stocks, because most of us will not survive. The only point is whether the intensity of the current war, intensity of its impact on the market. I firmly believe that overall the impact would be another maximum 2-3 percentage point on Sensex and Nifty. Beyond that, I don't see any major reaction from Indian markets.
All right. So essentially, what you're saying for our viewers to understand is that you do see near-term volatility, but in the long run, you see this to then become a localized issue. That is your estimate as of now. The developments we've seen till now. That is what you're anticipating. Sanchita, do you agree that in the near term, our markets, Indian markets, may see some volatility as well as the rest of the global markets, but in the long run, this situation may be localized?
Thank you so much for having me on your show, Sakshi. Always a pleasure to be here. And I completely agree with Sir on what he just mentioned. Because, yes, if you were to see at a various lot of factors right now, near term, medium term, and long term. So, near term remains to be seen how our inflation is affected by oil prices, because it is touted as a figure that every $10 increase in oil prices has an effect of 0.3 percent on the inflation in India. And how much is our oil allocation to the consumer price index, right? CPI, it's around 6.84. So there's a concern on the current account deficit. There might be concern on the rupee. But if you were to keep aside all of these short-term concerns, one would actually see that India's oil basket has been diplomatically very, very well managed last many years. In fact, we always manage to get our buying price really low, irrespective of geopolitical tensions which have happened over the last 2-3 years, starting from the Russia-Ukraine war and concluding now in the Middle East tensions. So oil basket, we as a country are managing to keep it at a decent level for us. But there is a concern on monsoons being a bit too much this time. So how food inflation gets affected will also affect RBI's monetary policy, the monetary policy meet. Because right now, what is important to note is that the industry is firing on all engines together. But having said that, what the markets are looking for is justification for the extremely high valuation in the mid and small caps, right? Which translates into the earnings growth. Now, if your monsoons are a little bit on the heavier side and RBI sees that the food inflation is coming back, then they might not do the rate cuts. And if rate cuts do not happen, it is a net negative again in the short to medium term for equities, because companies are looking at lowering their borrowing costs. So all of these things are very related. Short term volatility definitely is there on the cards. Geopolitical tensions, whether RBI will cut rates or not, whether festive season earnings growth will happen or not, all of these factors will increase volatility in the market in the short term. Long term fundamentals are very much intact, and I think we'll be able to tide over these volatilities.
All right. Mr. G. Chokalingam, to those seeing that, look, the markets were just looking for a trigger and now they have that trigger. What would you say? Is this just the fallout of one trigger that the market was anticipating or needed in a way? Or is this now something that, investors must be worried about and be cautious going forward about?
Yeah, very interesting question. It always happens like this. The boom happens in the market, then some exogenous factor like this war or Lehman crisis, happens, and then market falls very badly. And of course, then subsequently everybody focused on the macro development rather than the valuation, which led to this fall. But interestingly here, it was waiting to happen. The valuations were extremely stretched, particularly in the small and mid cap, not so much in Sensex and Nifty. That's why I've been saying that the Sensex and Nifty will not fall more than 1 to 3%. And in fact, when I say the long term, for me, in a couple of months or in a couple of weeks, I think things should settle down. The war should be regionalized one, and market would live with this. So, therefore, coming back to your core question, yes, this is a trigger which has led to this correction. And in that respect, considering the super rich valuation of small and mid cap, irrespective of what is happening in Iran, Israel, I firmly believe that many pockets of small and mid cap will see further steep corrections. And this market is showing one good healthy trend. The large caps are relatively better off compared to many small and mid cap. And within the small and mid cap pack also, the quality stocks in terms of management quality, balance sheet quality, and valuation in a comfortable zone, they are holding up even in this market. So therefore, the takeaway point for the investor is don't get panic. Definitely, there is not going to be a crash in the market. And two, don't put in everything in small and mid cap. Ensure that around 50% of your equity money is in the large cap, and in the balance 50% also 5 to 10% you keep cash and gold. The remaining 40% you put it in the quality small and mid cap stocks. That is where one can create a lot of wealth. When I say quality, don't compromise on management quality, don't compromise on balance sheet quality, and don't compromise on valuation, comfortable zone. Very simple common sense. If you are paying 50 PE, see that the company profits are growing at least by 25-30% on annual basis. So that's what when I say the comfortable zone. So you can take this common sense approach, and definitely you can use, one more dose of correction should happen after the news of Israel attack. So then one can use today and on the other day when this development happens to buy quality small and mid cap stocks.
All right, that's as far as your advice is concerned. Thank you for sharing that. But Sanchita, to those wondering, okay, what will then happen to oil rates and gold rates? Because we've already seen this surge. What would you say in the near term and then in the long run?
All right. So there's another factor. I'm glad you mentioned the oil and gold. Oil will remain to be volatile because of the geopolitical tensions that is happening in between Iran and Israel. Iran being a big exporter of oil. But having said that, India does not. I mean, if you were to look at an oil basket, we need to question ourselves: how much are we actually buying from Iran at this point in time? So, because India has very strong diplomatic relationships with other oil exporters, and I think we are managing quite well on that front. Having said that, there is another factor which is playing on in the markets is the fact that China has released a very large stimulus package for their economy, right? And this comes straight after the Federal Reserve in US has cut their interest rates to a 50 bips aggressive rate cut. Now, it remains to be seen in India what is happening is, our rates are quite high because we're still waiting for the food inflation numbers to come in, which affects the common man. But having said that, industry is looking forward to rate cuts because we need to be competitive. In the situation of China releasing a large stimulus package, a lot of FII holdings, be it in large cap, mid cap, small cap, are looking towards allocation in Chinese markets because they feel the valuations are not so stretched vis-a-vis the Indian markets. Now, if one were to combat that, if we can have a rate cut, sooner the better, because festive season will impact earnings growth very substantially on our consumption. And moving towards a lower interest rate regime will actually help the markets in the midterm to the long term.
All right, all right. So that's essentially what you're seeing for the near term and the long term as far as equities as well as commodities are concerned at large. Thank you so much for sharing your thoughts. And of course, we will continue to track the situation and the impact it has on equities and commodities going forward.
Thank you so much.